Good morning. It is Friday, March 29th, 2019. I am a little bit less nasally than last week, but still not completely recovered for what was a miserable winter in Wisconsin. And between that and the airplane rides, somebody got me. So let's talk about the market. As has been the case for the last decade or so, probably before that, but really the last decade, everybody's crying bubble, crash, crisis. And I think that we keep trying to talk ourselves into bad things. Now, I'm not here to tell you that the world is rosy all the time, and I'm not going to tell you that we're not going to get a big stock market correction soon. However, I think that we just have to continue to work to maintain our wits, control our emotions, and look at the evidence as it is presenting. So, if you're a subscriber, you know that I wrote an article titled A Market in the Middle, and basically talking about how the stock market could jump a little higher before it jumped a little lower or fell a little lower. And I just want to review, money flows are still pretty decent. This is a week old, but as I'll show you in a moment, they are still doing all right. And today is a pretty good up day in the market, in particular across energy. And we are going to talk about energy in depth today in the second part of the show or workshop or webinar, whatever this is, because there are some major changes going on in the energy landscape that are long-term negative, but short-term very positive for oil investors and gas investors. So we will get to that. But let's just take a look at the market broadly first. In this chart, which I did February of last year, I show the major support levels for the stock market. And the first one was right in this area here, which is what we ended up correcting to. That is where the December correction got to. So had we traded as effectively as we forecasted, that would have been a great move, because the stock market got to about 290, came all the way back in the 250s. I forget exactly where. And the one that we're afraid of is this 220-ish level, the big support level here, before the rally after Trump. So this could all be given back at some point. And I would be surprised if we don't give all of this back by next year. So by sometime next year, I fully expect us to get into this area. If there really would be a crisis, the kind that all of the self-proclaimed pundits and bubble callers and everybody else wants to say is going to happen, then we could get down to here. Now, I don't know that we get here anytime soon. I don't know if we get here ever. It makes sense based on the amount of money that's been printed and based on the time frames involved, that this is the level that we will get to not once, but twice. So over this very long period of time, say over the next decade, we could come down to this 220 area soon, big rally, and then come back and hit it again. In essence, breaking through the resistance, double bottoming, and then the next segment up. In fact, I think that's the most likely scenario, and I will make that case more clearly in coming months. I do think next year, 220-ish on the S&P 500, and then a rally way into the 300s, probably towards 4. And then ultimately, we have the baby boomer bust, The baby boomer bust is coming, and there won't be anything to stop it unless we really plan ahead, which we have never really proven to do. So we'll just wait for the crisis. Now, that could change. Maybe the movements in Congress and across society are going to be positive. And while I think a lot of the politicians have their heart, the newer politicians have their hearts in the right place, I think they're kind of ignorant of the way that things really work. And I think there's going to be a lot of bad policy implemented before good policy is implemented. I hope that I'm wrong about that, but history has proven that we usually try everything that doesn't work before we do the things that do work. Winston Churchill said something to that effect as well. So let's just worry about the next move. Take a look at the SPY here. Put in MACD, put in shaken, put in on balance volume, which is another measure of money flow that's a little bit different, not quite as sophisticated as shaken, but it shows change that makes, the pictures make sense. So on balance money flow rose, stock market rose. On balance money flow started to chop around, stock market started to chop around. Pretty interesting, right? Shaken money flow, which is more concerned with rates of change, rose, stock market rose, started to drift down, the market got choppy. If this turns down sharply and this turns down, now they're kind of in alignment, both moving in the same direction, kind of sideways, then this would probably come down. And the Elliott waivers are having a bit of a hard time right now because they're not sure exactly which wave and which parts of the wave they're in. And that's because this has been a very complex series of movements, and they just haven't been as definitively defined, right? Definitively defined, right? I looked that up. And easy to analyze. So this is a complex, difficult move. And for those of you trying to divine which way things are going to go, I think that you should stop and simply ask yourself one question. What is my risk tolerance? That's it. So if the market does another digger like it did in December, in fact, it got a little lower than I had identified. I had identified about here, and it got all the way to here. So an extra 10% lower than what I had forecast or what I identified. If the market goes down from 280, which is where it is today, to 235, how are you going to feel about that? Will you be able to sleep well enough at night while it works its way back over probably a longer time frame than this, right? We're not guaranteed V-shaped recoveries. So if the next time it comes down here, maybe goes a little further, what if it hits, chops along, and takes 3 times longer to come back? That would actually be normal. It would be normal for a 3-month correction to take about a year, 9 months to a year to make the money back. This time it happened very quickly. So as we've talked about in the past, markets are moving faster and faster and faster. Why? And we've talked about this in the past. It's because there's not the underlying buy the dip marginal buyer out there anymore. The money from the Federal Reserve that was going into the markets for years and years is now coming out, although that might change imminently. to fully neutral here. I don't think it's going to take as long as September, which is what they identified in their last meeting. I think the Fed is going to pull back on quantitative tightening potentially by next month. If not by next month, I'd say by June. So I don't think it's going to take all the way till September. I think it'll happen between April and June, sometime in the second quarter. And that would be very positive for the markets for $50 billion a month not to be getting sucked out of the economy. One thing that could happen is maybe the Federal Reserve, instead of getting rid of the $50 billion a month, which we've been talking about for a long time now, way over a year, the $50 billion a month that they're pulling out of the economy off their balance sheet, that translates to money coming out of the markets and the economy. They could continue to retire mortgage-backed debt, which is $20 billion a month, and then the treasuries, let those get back into the market because there's demand for those. So we'll see if they get rid of the entire $50 billion a month, or maybe just cut it by the treasury amount, which is $30 billion a month, and that'd be the equivalent of $30 billion that would be available in the markets and in the banking system and in the economy again. So we'll see. It would be stimulative, not because it is stimulative at the nominal level, but it's stimulative because it's the rate of change. It is the change in what was going on from money coming out to money not coming out. So even though money's not going in, it's money not coming out, and it's available again. So we'll see something along those lines is going to happen. And we watch all these money flow indicators, and they're all kind of turning over, and that's scary because people think, oh my gosh, the next thing is to fall. And usually if you keep an eye on these, you get between a day and a week, even up to 8 or 9 days, to adjust what your portfolio is doing. So what do we know about stock market inflows and outflows? Well, I can tell you something, and this relationship has diminished over the last 20 years, but it used to be the first week of the month was the best week of the month every month, because money flows from institutions went into the stock market the first week of the month. It had to do with pensions, other types of institutions as well. Because there are fewer pensions now, and because pensions are in long-term distribution, that relationship has diminished, but it still exists to some extent. So next week could be a very good time for you to lighten up on your positions if your risk tolerance is telling you that you should. One thing that I've been doing for the last couple of days is looking at what I own, deciding how long I want to keep it, and how much of it is really a core position. So we were able to buy a lot of good stocks that last week of December, Google, Amazon, things like that. And they're up 10, 15, 20%, whatever the case might be. We could take a look at a stock like Google, which, again, I believe they'll have baby Googles eventually. But I sold a couple shares up here. Now, I don't know that it's worth it at smaller account levels to bother, but I manage enough money where, trimming 0.75% made sense, right? So if you have holdings that are demonstrating charts like this, take a look at First Solar. I love First Solar long term. However, stock has made a nice move. We bought it in the low 40s. It's now in the low 50s. You might want to take 20% of this position off. right? So that's a sizable enough position that you can reduce it if it's grown from 2% to 3%. If it's grown from 3% to 4%. You might want to bring it back to a 2% position, or maybe even a 1% position. So right now, I think is a pretty good time to, a little bit of a negative divergence, not a lot of commitment on the money flow, although longer term numbers look pretty good. Still a little bit of negative though. First Solar might be one that you can trim, and you'll probably just want to add it back because long term, this is a stock that could triple, quadruple, quintuple, whatever the words are, go up a lot in the next 5, 6, 7 years. Why is that? We'll talk about that here in just a second. But, go through your portfolio, do a little trimming next week, I think. I'll write about it over the weekend. But bring your asset allocations in line. If there's anywhere where you have calls that are getting a little bit long in the tooth, you may want to try to cut your losses, with the exception of the energy, which we'll talk about in a minute. But I think that, you have to manage your time, manage your calendar on your calls so that you don't start to lose a lot of time value, which usually happens in, if you've bought a leap or something, it'll start to happen in the fall. But if you have an option that's expiring in June or July, you want to start managing that now, because about 2 months ahead of time, it starts to roll over, and then that last month it falls off a cliff. So, just be careful about that. IWM, which is the small caps, is, changed a lot in the last 20 years. The one thing I can tell you is that this used to lead the market all the time, and I don't even care. There you go. So look at that, small caps. Money flow fell off, and that just kind of picked up in the last couple days. Rise, levels off with a drift down. If this doesn't rise, right, if it turns over, money flows turn over here, they go negative in a week or two, then this comes down. Again, I don't know what's going to happen in a couple weeks. Nobody does. And for those who will try to tell you which way the money flow is going to go, they're also trying to tell you what the news of the day will be. So one thing that I always caution people about with technical trading is, if you're going to technical trade and you're going to claim that technicals are all that matter, I don't really want to hear too many of your opinions on fundamentals, because that means that your fundamentals are impacting your analysis of your technicals. And I'm not saying that that shouldn't be the case. I'm just saying to be true. So if your fundamentals are going to impact your interpretation of technical analysis, then you need to be very careful about what your fundamental analysis really is, and put the amount of time into it that it requires. And I've talked about the amount of time I spend on things and the resources that I have been able to accumulate over the last, since about the last decade. I know that my fundamental analysis is pretty on the money. And when I hear other people's macro analysis or fundamental analysis, I know what's on the money and what's not. So, most of the time. And I could tell you that there's a lot of bad advice out there. And I'm going to call out Jesse Colombo again. He bubble talks nonstop. And he's been doing it for 10 years, right? He got a little bit lucky on the financial crisis. He didn't really call it. He just kind of made some passing comments, and, it was part of his shtick. And, the clock hit midnight. So will the clock hit midnight again for the people who say bubble, crisis, crash? Yeah, absolutely. But midnight is only, one time a day. So you just can't buy into that negative hype. You have to take the actual analysis and understand what are the big impacts on the economy. And in the short term, we've talked about this, it's going to be the trade deal. Are we going to get a real deal, a no deal, or a fake deal? Well, the idea that we're going to get a real deal with China is almost zero, pretty much zero, because they're just not going to change the structure of their economy or the way that they rule the country. Not going to happen. Now, will there be a no deal? I've talked about that possibility. I'm not sure that anybody can tell you with any type of certainty whether there will be a deal, a no deal, or a fake deal, right? There's not going to be a real deal, but there will be a fake deal or a no deal. And the fake deal, as we've talked about, will go something like this. A lot more trade from China buying U.S. goods, particularly agriculture and energy, and some technology, semiconductors in particular, which is why we talked about NVIDIA and Micron again this week. And that would be about it. And to me, and I've talked about this for over a year in the trade articles that I've written, that would be fine. So, if you're new to this broadcast, go to my Seeking Alpha profile and look at the articles from a year ago that I talked about trade. Search the word trade under my profile, and you will see that I've been saying a marginal deal with China would be great. If we can sell them more food and energy and tie more into their economy and more technology and get some, some promises to them that'll be under-delivered on and stretched out and everything else on protecting IP and things like that, and not having to do certain things with partners in China and giving away things that we don't want to give away. If we just attach price to the things that they want, then that's fine. Because ultimately they're going to get the technology they want, and we might as well be the ones to sell them our second-tier stuff, right? We're not going to sell them our best stuff. We can sell them our second and third tier stuff. It's the same way that we handle weapons sales around the world. We don't sell people our best bomber, or best jet, or best gun, or whatever. We sell them our second and third best stuff. Depends on how much we like them. If we really like them, we sell them our second best stuff. We don't like them so much, but hey, we want the sale. We sell them our third or fourth best stuff. And then if we get mad at them, we don't give them spare parts. That's how that works. That's really how that works. We don't give them spare parts. So, if we wanted to, for example, play tough with Saudi Arabia, we'd stop giving them spare parts for their jets. That's no joke. That's how that works. So, we'll take a look at how all of this works. And remember, when somebody's getting ready to screw you, stab you in the back, they might stock up on the stuff they need for a while, right? So, that's what I've talked about with China, and that's what we'll talk about in a second with Saudi Arabia. So when we take a look at charts like this, we just really have to understand that small cap stocks, which clearly offer the biggest potential upside, also offer more downside because not a lot of people invest in the space as much as they should. So this is where the big inefficiencies are. Small cap stocks have the big inefficiencies, which is why when I pick out stocks, I try to go a little bit down the capital scale because there's less coverage by analysts and there's less investment by your SPY investors and your VOO investors and your QQQ investors. But when these companies start to grow and then they get the attention of the large cap investors, now all of a sudden you've got that really nice S curve, or get that nice run for 2, 3, 4, 5 years. So we're looking for companies in this universe, but investing in this index probably is a lot tougher. And in fact, and we did this twice in the last year and a half, if I decide that I want to take hedges out, and I'm pretty sure I'm going to know in the next week or two, then we'd probably buy puts on IWM, because IWM will take it in the chin, right? we can compare this to SPY and QQQ. Go back 6 months, normalize. Who did the worst? Look at that, right? There, that's the one that did worse. So if you're going to get hedges out there, oh, my dog's here, somebody in the yard, right? This is pretty much the start of the fourth quarter. Small caps did the worst. Yeah, you can short tech, short the S&P, but you want to short this. It has a lot more beta, a lot more volatility. All right. So let's talk about something that I've been talking about that has to do with fossil fuel divestitures. And the change that is going on is nothing short of a tsunami that is currently pulling back the water out of the bay. The low tide is first. Now, when the tide comes back in, it'll be pretty good for us, right? It'll float all boats. And in the short term, it looks like that's going to happen. But sometime in the next decade, fossil fuels are going to get crushed. Just absolutely crushed. And when I say that I'm going to short coal right back into the ground, I mean it. And I think that that probably starts maybe by the end of this year is when I start taking short positions on coal. It's been drifting down, so I don't know. I might not actually get the opportunity to do it, but coal is in some big trouble. If you're a FA trader, you got this article first. I did a slightly updated version for margin of safety investing this morning, and fundamental trends, we'll get it this afternoon. I just, each article is a little different because each crowd is a little different. But what we know is that over 1,000 institutions have started to divest. And we talk about what? Money flow all the time. So money flow is coming out of fossil fuel investments long term. And that is something that we have to be aware of. It means that we have to have an exit strategy. It doesn't mean that it's all going to happen this year, next year, the year after. But if Congress and the presidency go Democrat in 2020, which is what I expect, although the Senate's a coin flip, we just have to be aware of that. And because that would accelerate things even more. The reality, though, is even in a Republican-dominated Congress, the institutions are still doing what they're doing. And when institutions sell, somebody had a question on this article. And he said, if institutions sell, that really isn't that big of a deal because other people can step in. Well, that's completely and just mathematically wrong. That's not what happens. If institutions are big sellers, things get crushed. And that is part of why we've had a hard time making the trades in the energy space, is that we are fighting against a growing outswell, a growing outflow of money from fossil fuel stocks. And these institutions are not just saying we're doing it for ethical reasons. They're fiduciaries. They have to make an investment reason, right? They have to give an investment rationale as to why they're taking that money out. And their rationale is, look, in the long term, these stocks all have problems. We want to get out ahead of time. That's their rationale. And so they can take their ethics and say whatever they want for marketing purposes or whatnot, but they also have to give the fiduciary equivalent of your best interest. So if they can't say that it's in your best interest, they can't do it. They recognize a massive trend that's developing, and they're perpetuating it at the same time. So At what point does this become huge? I don't know, but sometime soon. And it's accelerating. But in the short run, we have a lot of bullish fundamentals in the oil sector and still enough baby boomer and institution money that wants to be involved if they can make the trade, right? The institutions know these aren't great long-term investments anymore. They know. But they're willing to trade against you. Trust me, they are willing to trade against you. So that's what they'll do. If you're going to play the game, you better understand the rules, because the rules are they try to take your money. That's the rules. They're trying to take your money. And they will say what they have to say, and they will lobby who they have to lobby, and they will move money the way they have to move money, whether it's dark pools or options or, looking one way and, and selling to that guy but buying from that guy. They're trying to take your money. And they know that these investments have problems long term. One of the things I wrote about was Norway's sovereign wealth fund is talking about selling off up to $37 billion in oil and gas stocks. They are going to sell off $7.5 billion for now. That other $30 billion is going to get sold off. And it's ironic because Norway's sovereign wealth fund used to be called the oil fund. Why? Because that's where they made all their money. So it is a tangled web. Why divestitures matter. We just talked about that. See, money flows long term or falling off. Talked about some definitions. And there's a great rotation that's just starting. And that great rotation is from the fossil fuel stocks and kind of a usury finance economy into alternative energy, smart grid, smart everything world, and a more sustainable financial structure. So, some of these tech companies, tech finance companies, Square, PayPal, right? PayPal is one of our 6 core holdings right now. It all has to do with this theme of a big rotation. So while cryptocurrencies I don't think are that big of a deal, there's a role, but it comes down to this whole idea that has different interpretations and different people think different things. But the idea is to give people more autonomy, right? More freedom. And if we can get out from under the yoke of high interest, fees, and things like that, it gives you an edge up. Ultimately, we have to find ways so that wealth inequality shrinks, not expands. But that's in the context of all of us trying to make more money, right? So they're opposing forces. And we have to monitor the changes in the way the money flow moves, because underlying it all, right, it's the old saying, follow the money. We have to see where the money's going and whether the curve is bending up, going up and bending up, going up and starting to turn over, going down but starting to turn up, right? Which way do these curves go? What are these rates of change? Eric, this guy is one of the guys I hung out with in New York, smart kid, 30-ish years old. He's understanding some things. And, I live in a world where a lot of people think that, Friedrich Hayek was a great economist, and he was. But the whole idea, Austrian economists, school of thought, that business cycles rule everything is wrong. They don't. And even if they should, they won't. So we always have to take an account for that. And that's something that Eric does with his rates of change. He's just telling you, hey, this is the way things are going. Understand that it's accelerating or decelerating, right? Up or down, accelerating or decelerating. Those are the things that we have to follow. And in this, from fossil fuels to alternative energy and smart grid, it's accelerating, right? So fossil fuels are chopping along and it's gradually getting legs cut out from under them. Alternative energy is growing and the curve is accelerating. So we must have an exit strategy for fossil fuels. So let's talk about that. What's going on in the Middle East? 2 years ago, I wrote an article that I got criticized for, saying that there's going to be some sort of Iran-centered war. And I still don't deviate from that. I think it's going to happen. Now, I don't know how that war goes, but we are starting to see some major shifts in the Middle East. Turkey, which we haven't talked a lot about. I've talked about Erdogan a couple times. Erdogan, I don't know, has formed a new Middle East alliance with Qatar, Iran at the center of it. And there is a very good possibility that war breaks out between the two new factions in the Middle East. So on the one side, you have Turkey, Iran, I believe Syria, and Qatar. And on the other side, you have the Gulf Cooperative Nations, right? So this is obviously the potential shock to the oil markets that I've said is possibly coming. Put that aside. Okay, so here are the new members of the bloc: Turkey, Iran, and Qatar. And then these countries have actually submitted to be in there. Jordan surprises me. So I think Jordan is probably irritated with the whole Jerusalem thing. That'd be my guess. I haven't checked up on it. But this new bloc, man, that's there's going to be some pushback, right? And Iraq, they're kind of a swing player there. That's a big deal. Syria being in here is bothersome because of the heavy Russian influence. But, we have the Air Force base here. So how is this all going to play out? I don't know. But I think there's going to be pretty serious pushback against Saudi Arabia. And right now, we're on Saudi Arabia's side. So who knows? It'll be complicated. But there's a very good chance that you see oil prices rise because of this, either slowly and then suddenly. So what does that mean for investments? It means that we could see certain investments go up a bit. I don't like XLE because I don't like Exxon and Chevron, and look at that. They're a third of the portfolio. I don't want that. They're 40% of the portfolio. I've told you why I don't like Exxon and Chevron over and over and over again. So if you have Exxon and Chevron in your portfolio, I'm categorically telling you that you need to find a way to sell those by soon, next 3 to 15 months. If you don't, you are warned, and I will someday be on the other side of the trade, and I will take your money. Now, I'm going to tell you a little story. When I play poker and somebody pisses me off, I usually don't go on tilt. I usually shrug it off, but I often look for an opportunity to shake the person up. So I'll give you a story from the other night. Was up a lot of money on a poker table, and a kid sits down a couple seats to my left, and he starts betting at me. He was new to the table, taking his shots at me, and he took a pot off of me that the odds were heavily in my favor. I believe I was a 2-to-1 favorite, which is, he probably actually did the right thing there if he thought that he was going to get paid off. However, I knew what he was doing, so I didn't pay him off. He won the hand, but he didn't get the extra 100, $200 out of me that he was hoping he'd get. And he did it again a couple hands later, but I had adjusted my play, and I got into the hand with a pair of kings, very well hidden. Kid next to me bet. I called with kings, and then this kid 3-bet us. He raised the stakes, and the guy to my right folds, and it gets back to me, and I 4-bet this kid, and he's looking at me, and I said, I'm just tired of you betting at me. He thought about it for a second. I said, I'm willing to gamble. He thought about it for a second. He jams all his chips in. I call. He has a pair of jacks. Did not get the jack. I took all his money. I'm going to do that to you if you own Chevron and Exxon in a couple of years. I promise. That's what's going to happen. So I talked that kid into making the call, and then I took his money. I hope that I'm talking you into selling these stocks, because otherwise I will take your money. And that's all there is to it. Exxon and Chevron are too big. Their balance sheets are not good enough. Their cash flow is not good enough. And nobody is going to buy their assets from them. So they're going to go through a divestiture process where they split those companies up at some point. And one of the companies that comes out of it will probably do well, because that'll be the one that owns the real estate. The downstream, the gas stations, things like that. They can convert those. It's real estate, right? God only makes so much. But the drilling companies, the pipeline companies, everything else, the refineries, big, big trouble. So I don't know how much more strongly I can tell you guys to freaking find a way to sell Exxon and Chevron on strength. The place to be is the smaller, more focused drillers, right? California Resources had a big run because they do heavy crude over there, but their balance sheet is horse crap. The company I like is Devon Energy, right? That's the one that's been spitting out all the cash. We have calls on Chesapeake. Why? Because I have told you over and over again that they have the right management and the right assets to turn everything around. And ultimately, Chesapeake could be, in 2 or 3 years, they could be a debt-free, get this, debt-free, net debt-free company with the best natural gas resources in the country. They could just be spitting out cash in the next few years. Pioneer Resources, we have some calls on. Continental, we've been using. Concho, I haven't, but you could have. Marathon Petroleum Corp is the one refiner that I really kind of like, and that's because they have more light sweet crude processing capability, right? The merger with Andeaver, which was the merger of Tesoro and Western, right? They built a heck of a company there. Parsley Energy, we've had some calls on. Antero Resources finally bottomed out, and it's been coming off its bottom. The focused companies with good balance sheets that can return cash and actually do have good bolt-on assets for the companies that are bigger than them, or for companies that they would merge with for efficiency's sake, which is what we've just seen a wave of, right? We just saw the wave of efficiency mergers, and there will be more of those. So, if you're working in the oil and gas industry, be careful. One of my clients / subscribers was working at Halliburton, and he's, he quit, and he went and got an MBA, and he's going to make a lot of money. What was the company he just said? I forget what the company is. Some company in Seattle that really is in the whole sustainable movement. and just big conglomerate, going to do pretty well. So in any case, these are the companies you want to cherry pick. Why? Because everything in the Middle East is saying to us, hey, oil's not going to get out of balance again. And the one thing that you can remember and take this to the bank, and this is why Exxon and Chevron are screwed. They can't make more money. Can't be done. Why? Because if they start drilling a whole bunch offshore, Saudi Arabia and the Middle East can just pump more, cheaper. Saudi Arabia can bury offshore drilling anytime it wants. So they're trying to send that message, and they started, we talked about this already. They're trying to send that message, don't you dare do a lot of long-term offshore drilling. And what have Chevron and Exxon responded by doing? They're trying to get as much out of their short-term shale plays as they can now. So these breakups will be spectacular when they happen. All right. Let me take a couple of questions. Any stocks you want to hear about, take a look at. I figured out how to use the duplicate button. So now I don't have to open up separately. Just boom, hey, duplicate. Any questions, or can we call it a day? CD. So Core is one of the companies that I like if silver and gold are going to do well, and a junior miner. And it took me a long time to find these guys. They're on the dip right now, but I think that this is a company that if you want to sell puts on, and I have put orders in, I just don't know if they executed. You can buy this stock. I think down here is a pretty good spot. Take a look at the SWOT report that we have on it. What just happened there? Well, my charting just went nuts, or what just happened? Oh, okay. I did something. All right, what just happened? Oh, I know what I did. Used the wrong box, didn't I? All right. There we go. Feel much better about that. So, let's see. There we go. So you have the negative divergence there. That's why it's falling off. It's just about oversold, though. So I think we should expect that these probably start to turn up here in the next few weeks. And, you know, Avi talks about a big rebound coming in gold and oil, gold and silver. I don't know that, but this is cheap and it's highly leveraged. So you're not risking a lot. And if gold and silver do rise, and these guys, you know, their silver tip mine, which with the lead, and they have a couple other minerals, is a good mine. So, you know, take a look at this company. It's a company that you could put in your portfolio for a couple %, and it might all of a sudden triple or quadruple for you if we get one of those rallies in the metals. And, you know, now all of a sudden you're like, huh, you know, that offsets a lot of losses in other places. I don't like pipeline companies long term. I think the gas companies, the reason that I've been in Kinder Morgan and Enbridge is because they're natural gas focused. But in the long term, they have major problems because they're not going to be able to grow anymore. They're not going to be able to grow. So, and these are companies that, because they pay a dividend, people go, oh, I love the dividend. I like the certainty. First of all, did we learn nothing from a few years ago? There's not really a lot of certainty, right? If there was so much certainty, why did that happen? Right? If there is so much certainty, why did this happen? What does this look like is going to happen next? Right? There's some, you need an exit strategy for these too. Kinder Morgan, biggest natural gas pipeline network, Enbridge just caught them. They're basically the same. But if the pipelines were so certain, why did this happen? It's because when oil prices fell, these guys got hurt real bad. Now, I don't think that this risk exists anymore, but I don't think they're ever going back up here. I thought when these guys were 15 that they had a shot at 30, and they might. Kinder Morgan might get up to 30, but it could chop along in this range forever. And I think chopping along in this range is a great enough risk that this is a sell the rip stock, right? You get one of these rallies, you sell it because it's probably coming back. Same thing with Enbridge. And the other pipeline companies are worse. Now, the exceptions are some of the smaller pipelines. They have like one route or two routes that you know are really good, and the reason they're undervalued is because nobody's heard of them, right? You find those inefficiencies in the small caps, and you can exploit those. But in general, pipeline growth is never going to happen again. Just not going to happen. So you have to be able to think clearly about, okay, is that 4% dividend worth having essentially no growth? Why would you take equity risk for a potential single-digit return? Better off owning a high-yield bond. All right? And kinda, I mean, how many times do I have to tell you that? 49er fan. How many times do I have to tell you that I like Encana and I think it's going to go to around 20? Should I tell you again? I think Encana is going to go to around 20. CDEV, yeah, they're very well managed and they've got a very good space in the Permian. There's nothing that's changed in any of these. Yeah, why do you guys keep asking those same questions about these companies? Price doesn't necessarily mean that the stock sucks or the stock is good. I talk about the companies. These are good companies. They're in the right space, right? These are stocks that are over here. They're held in here. And Kana will be back in here. It's lower right now. I mean, they might not even hold it at the moment because of the merger. But I would expect that they'd be they'll be right back in here. Should we take a look? Take a look. If you haven't done this before, if you own an ETF or an ETF owns a stock of yours, go take a look at the holdings. So this is updated better than Y charts. Devon Energy, Chesapeake, all right, we're on the 2-minute warning. Yep, take a look. Here's your CDEV, right? No, they're not in there yet. So that's something. So Encana is going to end up back in this ETF. It's not right now. I think it has something to do with the merger. So I think they're probably gonna get some buying from the ETF here at some point, and maybe that's what was going on. The EC, they had a little bump. Maybe that's what's going on right now. Hard to know. Hard to know. But this is a company that just doesn't get respected. And the market is wrong about this one. When will the market wake up? I don't know. At some point, somebody, probably somebody very big, makes a bid for these guys. And this chart is set up to blow up. It just, bam. That's what I think. I'm not going to change my mind. Lumentum. I think these guys have been doing a good job since the bad thing happened with Apple. They've gotten back to par. If you're in Lumentum and you're getting close to even, I think you need to figure out, do you want to hold it long term? I think that this stock is probably worth trimming, because we got in the upper 50s, right? Probably worth trimming because I think that the understanding of the market of Apple is still deficient. And these guys, while they're going to broaden their client base, which will be good for them, is still Apple reliant. And the replacement cycle for Apple is getting stretched out just like it is for everybody else. So while Apple is going to add video and music, more music, and the news service, I'm telling you, looks like it's going to be awesome, streaming and whatnot, and the movies, that doesn't help Lumentum. They just want to see more phones built. And the reality is that Apple is going to move sideways on telephones for a very long time, right? It's going to be single-digit growth rates only, and it's going to be replacement cycle. Every 2 to 3 years, people replace their phones. That kills a lot of the growth story for Lumentum until a lot of people start buying phones other than Samsung, because Samsung is the one that's vulnerable. And as those Samsung phones get replaced, the question becomes, will they get replaced with phones that Lumentum has a lot of, stuff in? So I would trim this. I don't think it's one of my 20 to 30 favorite ideas. For sure it's not. But it's something to watch because they could have some sort of catalyst develop down the road. It's a company to be aware of. But I don't know that I want to be in it right now. Hope that helped. All right, let's call it a day. We're going to be just short of 1 hour again, so lots of minutes in the 50s. All right, everybody have a great weekend, and I will talk to you again shortly. Keep an eye out for the new articles. By the way, Fundamental Trends is now up and running, and I'm going to be updating the articles this weekend, and then running some specials in April. And this service right here, if you're a trader, this is right. If you're a swing trader, this is the one that you're going to want. And I actually am going to close it at some point because I want the integrity of the trades to be protected. So once we get several hundred subscribers to this, done. It's closed. And we have 80 right now. So keep that in mind. If you want to do swing trading with me, a couple of requirements. One, you have to have some understanding of technicals and some understanding of options. You don't have to be an expert. I'll get you up to speed, but you can't come in at zero. I don't have time to teach from zero. So come in with some basic trading ability, and we will look for setups for making 20, 30, 40, 50% on our bad trades. right? Because the swing trades that I do, I'm looking for doubles and triples in short periods of time. The reason why you have to have a lot of them is because obviously you only put a couple percent of your portfolio into anything that, you can lose 50% on overnight. So, if you want to do swing trading, I'm gonna let you in on all my swing trades here, and I'll walk you through them. We have a nice chat room built right in, right? So the chat room is in there. We still have the forums. So when you want to talk about long-term investing, you come in here, go to the research library. You want to talk about stocks, ETFs, alternative investing. We still have some of the legacy posts. I imported them in. Very short lists, right? I'm going to write an update on T2 Biosystems, which is not really a margin of safety investing stock, right? Somebody did ask me about T2 today. It's not a margin of safety investing stock. It could be a stock over here, right? Because this is a higher risk stock. When people sign up for margin of safety investing, I don't think they want to have little small cap biotechs. So margin of safety investing, you're looking for, more steady eddies. T2, it could go up tenfold. It could. I don't think it's going to, but just because of the financial structure of the company and how much revenue they can generate, they're going to stay in business. But I just don't see them being a huge winner. But I could be wrong about that. There's people who disagree with me. All right, have a great time this weekend. Enjoy the new weather. Brewers won on opening day. Did you see that catch by Lorenzo Cain? Did you see Josh Hader pitch the 8th and 9th inning? It's going to be a weird situation in Milwaukee. Hader's going to close a lot of games over 2 innings, but he's going to have to sit for 2 days. So basically, we get to use him once per series. That means we need a closer. Hey, Craig Kimbrell, are you listening again? I know you are. Come to Milwaukee. All right, everybody have a great weekend.